So my pathway changed a little bit as COVID entered. I was then back in Switzerland and saw the opportunity of establishing something that was truly innovative and cutting edge in a very traditional market, I have to say. Private markets in general are by nature traditional and very, let's say, manually driven processes. But we wanted to change that. We wanted to create a fully digitally native infrastructure and improve the way we do finance in this market.
We have said it for some time that the relationship between traditional finance, TradFi, crypto and fintech is happening at the moment. And today we are happy to welcome Philip Berntsen that is helping us to explain the project that he is working on, which also is sort of a crossover project over these lines that I mentioned. Welcome, Philip.
Thank you so much, Martin, for having me.
And we both are Norwegians, but of course you are working on a global scale and you are living in and you are working out from Switzerland. But your project has the Frigg name, which is Old Norwegian or God, it's a goddess, isn't it?
It is indeed, yes. It stems from Norwegian Viking mythology, actually.
Yeah, so that's the inspiration. Is there any other type of some symbol in the naming, the chosen naming?
Well, it does have a nice abbreviation too, which you can almost associate with a future renewables investment group, Global. But that became too complicated. So we said, well, why not just stick to the narrative of Frigg being the goddess and the emperor of earth and air, which obviously has a very nice association to climate change.
Totally. But as we know, you are living in Switzerland and Frigg is also run out of Switzerland. But we need to know some more about you. What is your background, Philip, and what have you done before?
Yeah, absolutely. Happy to elaborate. And as you mentioned, Martin, originally I am from Norway. I was born and raised there. I have a Swiss mom that ventured to Norway a long time ago, but my background stems from Norway, and my academic education actually started out in Norway doing mathematics, which was to big disappointment of my father, I think, who was an engineer. But it so happened that my interest was predominantly in finance, and I wanted sort of the mathematical foundation to supply my knowledge in finance later on. But I started out with mathematics in Norway, decided to move to Switzerland after my bachelor's and gain some international experience. Continued my studies then in Switzerland. Had some, coincidence along the way that I met a professor that was teaching in Norway. I really liked him, followed him to Switzerland and continued with a master's here in Switzerland in the same topic. So mathematics actually was more insurance mathematics and financial risk, and that became sort of my specialty. I did that for 2 years. And then, as 90% of my colleagues ended up in banking in Switzerland, worked as a quant analyst, as they so called it back then. Did that for a couple of years before I ended up as a slide monkey, as I like to call it, doing PowerPoints for the back then COO of asset management. Was obviously quite interesting to get a global view of the bank and what they were doing. But I always had this urge to do something with a bit more, maybe wrong to say, but a bit more meaning and impact. And hence started to play around with the thought of doing something at the cross section of finance towards more impact-oriented initiatives. And having actually started out with looking at renewable energy investments a long time ago, due to a family, I would say, orientation, with my father having been in the space for a long time, I decided to pick up that ball and look into how to reinvigorate that market. So financing for renewable energy projects. So my pathway changed a little bit as COVID entered. I was then back in Switzerland and saw the opportunity of establishing something that was truly innovative and cutting edge in a very traditional market, I have to say. Private markets in general are by nature traditional and very, let's say, manually driven processes. But we wanted to change that. We wanted to create a fully digitally native infrastructure and improve the way we do finance in this market. So back in 2022, became sort of the incorporation of this company that we're talking about today, Frigg, that specializes in exactly that field. So to finish off my background story, I'm currently heading up as the CEO and founder of that company, and working together with a very talented team, eight of which based here in Switzerland, and two actually based out in Norway.
And if we look at the company and we look at the challenge that climate change are for all of us, on the homepage, guys are saying that climate change is a financial problem. Well, we all are used to that. It is has to do with our routines, how we are living our lives. It has to do with politicians. It has to do with regulation. But is it really a financial problem?
Yeah, it's a great question. And what we like to do at Frigg is sort of break things into numbers and be very quantitative and measurable about our approach. And we took basically the climate change goals or climate finance goals, the SDGs, so the Sustainable Development Goals, and broke them down into financial numbers, like what is needed to achieve the goals that we have set to address climate change. And the number that often flows around is 4 trillion. So there is a 4 trillion climate finance gap that needs to somehow be filled with fresh capital. And if you look at, so that's sort of the need, that's the target, that what we need to achieve. But if you look at the global capital markets, they're substantially bigger. So the total amount of capital flowing around being invested into not only climate related initiatives, but the whole bandwidth is quite large. We're talking about plus or minus 250 trillion of capital that is flowing annually. Now, if you look at it from that perspective, the challenge of solving these climate goals isn't that far away. Then you might ask yourself, but why isn't capital flowing in that direction? And that's why we argue, well, while the capital is there, it seems to have a very hard time being redirected or allocated to where it's supposed to be going. I mean, we were talking about COVID being a massive problem for the global society. And I saw this one chart once in The Economist, I think, where this was sort of the first wave of problems that we need to address. And then there was this even bigger wave in the back, which was climate change. So I think it's very apparent and present to everyone that we need to address it. And putting these two numbers in perspective at least gives me a little bit of hope that there is a very little adjustment that is needed to actually achieve it. And hence we say that it's a so climate change is a financial problem, simply because you can break down the targets into financial objectives and basically unleashing that capital flow towards where it's supposed to be going would solve that issue.
And then you guys have targeted one area that seems to have a problem. It is the green project infrastructure, mainly the smaller projects or the medium-sized projects, as I understand. What is the real problem here?
Yeah, that's a great point, Morten. And what we saw when we looked at this market, and you can even look at it from a developed country perspective or a developing country's perspective, but the problem will always remain the same. And that is financing of everything that is below a certain investment threshold becomes very difficult for the traditional financial system. And why is that the case? Well, because, as I said initially, private markets and renewable energy in particular is associated with a lot of manual processes. There are people in the back that are doing analysis and due diligence and processing these deals, filtering out what is actually out there and what should be invested in from a risk reward perspective. The problem with that process is that it's very costly. And that means, in another word, the overhead cost of placing money to some project becomes too high if the project size is too small. Now, generally, as a rule of thumb, that investment size is around 100 million USD. So any project below there isn't touched upon by the bigger investment banks, nor the larger private equity and private debt funds that venture into these markets, and they're basically left untouched. Now, what we see, however, from the demand, where do we actually need to develop, and also from a supply side of things, so where basically the question, where is the unrealized potential of renewable energy? It lies exactly in that space. So everything below 100 million. So, for example, in the developed market, where grid naturally has been developed sufficiently, you have a lot of smaller projects that are left untouched. Those we want to address. In an emerging market, where grid isn't as expanded, you need to start small and slowly expand the industry. So, especially in that segment, Morten, that you addressed, the small to medium sized is where we see the biggest gap. Not to say that the gap still is there to open up also for bigger projects, because as soon as you can reduce the due diligence or the underwriting costs of a project, well, it becomes all the more attractive also for the larger investors.
And what is then your solution? Because the project that can be some energy project at Vikersund in Norway or whatever, it can be, while the investors can be family offices in Switzerland or whatever. But you guys are sort of in between, connecting these two type of interest groups. And what are you exactly doing?
So very simply put, we've created a very efficient way to filter out and do due diligence and provide a package to investors that are looking to invest in this market that is investable, meaning a project developer comes in with a specific Vikersund project or that is a solar project or a battery project, and they need help to seek financing. And while their project in isolation is too small for a large group of investors to take, we help them first prepare the project itself for financing. We do the due diligence on it, so we are able to do a credit assessment or a financial viability assessment of that particular project. But now imagine we have 100 of those developers lining up and doing the same thing. And through the automized process, we can then also aggregate and create portfolios that offer diversifications to investors and allowing them to create portfolios that are attractive. So we're basically that binding glue between those two stakeholders to address their preferences. Investors look for diversification, lower risk, and high return. And developers, they see capital, but also help to structure the projects efficiently, help them prepare an investable package. Because remember, these developers that we have, they are not financiers, nor are they bank people. They're project developers and engineers, and they should do what they do best, and that is develop these projects. And hence, we add value in that sense because they don't have that staffing internally.
And when it comes to the investment then, how is the projects financed and offered to investors? Is it tokenization? Is it stocks? Is it bonds? Or what is it?
Very good question. So we looked at that securitization process, as it's called. So how do you package an investment into a project like this in the most efficient manner. In addition to that, how can you offer further utility to someone buying that security? So yes, we do use tokenization or the blockchain to issue investable papers or digital papers for a broad spectrum of investors to take part in. We do cater actually for both equity, debt, or different types of debt structures to be invested in. So we're quite agnostic. But what we see is that project developers, they prefer debt over equity simply because it's attractive for them to retain it. Also, from our perspective, it might make sense because you have aligned incentives. Developers that sells debt and retain equity have skin in the game. And investors that sit too far away, they might just want the passive income stream and not sit on the equity side where they might, want some kind of operational control. So we see debt most preferred and then going all the way down to equity, but we cater for everything. And everything runs on blockchain rails.
And what about the legal framework then? Because Switzerland is not a member of EU and they have implemented some legal frameworks for blockchain and tokenization independently of the MiCA thing that we are talking about, Norway joining the EUS later this year. So what does Switzerland offer that is different?
Yes, so we strategically wanted to position ourselves in Switzerland with the company exactly for that reason. So regulation within the blockchain world. Apologies. And Switzerland was quite early on pushing or publishing, excuse me, the distributed ledger technology bill that created a legal framework that was on par with traditional securities, meaning that any blockchain-based security, be it equity or debt, is as legally binding and on par in terms of legislation with traditional securities. The complexity, however, that we face as a global company connecting investors from everywhere to these projects is obviously that we need to be a bit aware of jurisdictions outside of Switzerland, which is why we initially only focused on sourcing investors from a Swiss-based jurisdiction, since we also did all the investments in a tokenized manner. Now, how does Swiss regulation distinguish from others? Well, it evolves quite fast. So MiCA is being published in the EU, as you mentioned, Morten. You have different legislations being pushed in Asia. US is also making another push, I believe, with the new presidency of Donald Trump. So it's hard to follow. But we have created sort of a standardized legal framework under the Swiss ruling that allows us to connect investors and project developers directly. The only constraint that we have as a platform is that we cannot, as a disintermediating entity, touch any securities or cash flow that goes between the two. If we would end up being a regulated entity as well.
Yeah.
But by default, since we don't, we only need to comply with rulings that are very clearly stated on the Swiss law, that if an issuance is below a certain size, you're not regulated. If you don't collect investments from investors and manage on their behalf, you also don't fall under a Collective Investment Schemes Act, nor the Banking Act. So we're trying to really navigate that very carefully.
So you're doing it what you call non-custodial way?
Yes, so that's a very important
Could you
point.
explain this for our more recent investors in the crypto game?
Absolutely. So as you mentioned, a non-custody or custody, we're talking of the space of how do you store actually these securities or tokens or digital papers, digital ownerships of these projects. Now, for that, you need a wallet or some kind of infrastructure where you can store it. And since it's very it's still a new market. Not a lot of investors, at least the ones that we're talking to, have the infrastructure to store it on their own. That is why we said we need to, as a platform, be able to cater for any investor, be it them having a digital wallet infrastructure or not. And hence why we opted in on what is called a non-custodial wallet solution, meaning we offer the solution, but we are not the provider that stores the tokens. It's stored on behalf of the investor, but under their legal entity name on our infrastructure. Hence, non-custodial. We're not the custodial. They are the custodial themselves, but we just help them set up that infrastructure.
So again, then you are the infrastructure and you make things happen sort of under the hood between the different parties. But you also used another name, which or word that we maybe also should explain. That is the ledger technology, because this is not on Solana or Bitcoin or whatever or Ethereum. It is built on top of the technology, but without the cryptocurrencies involved. Isn't that correct?
That is correct. So we said initially we need here also to abstract the technology layer in such a way that it becomes usable also for a traditional player. And actually, under the hood, it is the Ethereum blockchain that
Okay.
runs, but you don't need a cryptocurrency that to flow through what is called the smart contract that mints or creates the tokens or the proof of ownership of a particular project. So what we said is, while we want to have a blockchain infrastructure where the ownership rights are registered, we need to cater for investors being able to transfer in fiat money, so off-chain. So we actually do drive a parallel road here. While we do want to end up in a fully on-chain world, we actually tried that already back in 2023, I believe, and we saw that it didn't fly. So there you had to have USDC or a stable coin to buy these tokens. That has changed. You can now use fiat, but in return, you will always receive the token. And it will now also be stored on your behalf on the platform automatically. So the tokens are there, but it's all under the hood, as you said, Martin, and abstracted for the investor itself.
And this is then what the buzzword is, tokenization of real world asset, isn't it? Which can be stocks, it can be bonds, it can be real estate, but in your case, it is green energy projects, solar parks, battery. What are the different kinds of investment? The physical ones, I mean.
Yes. So our scope of interest for the platform is renewable energy as a bucket. Now, in that bucket, we have at the moment on the platform solar, battery, hydropower, wind, biogas, and waste to energy projects. So quite a broad spectrum of different assets in that bucket. But that's what we've specialized and also trained our vetting models on.
Okay, so theoretically you could offer gold and silver or whatever, but that is not your mission.
No, it's not. And I think it's a very important distinction, and also to be quite cutthroat on what you focus on, because in order to add value and bring, let's say, sensible assets on chain, there needs to be a mechanism where you filter out what are then good assets and what qualifies as a good asset to be brought on chain. And for that, you need know-how and processes and models in that particular vertical to filter that out. And I think we've seen enough in the past where there have been crypto projects or blockchain projects that have just thrown on assets that haven't necessarily added that solidity, and we want to do that. It needs to be green, of course, but it also needs to have a stamp of quality approval, and that's where our job comes in.
Will you say that this is still a hidden secret for industry leaders, for politicians, or for the broader society, that it's possible to use the blockchain and tokens, which is highly criticized, for good?
I would say so. I would absolutely say so. I think without exception, and I said initially we're operating in a very traditional market here with renewable energy. Um, the association becomes immediately, but is this Bitcoin or is this Ethereum or is this a cryptocurrency? And we always have to make the explanation that no, it's just simply leveraging this new technology to make the process more efficient and way less costly and also more secure. So it always depends on which stakeholder you're talking to. I would say on the investor side, they're definitely more educated on the topic than on the project developer side. But from our perspective and also the usage of our customers, the project developers don't necessarily need to know very much about the technology because they just need to build good projects. Whereas the investors, however, they might actually benefit quite a lot from a knowledge in that space. Because while they hold the tokens on our infrastructure and they're stored there, they can potentially use that in other blockchain protocols where they can use the tokens to do leveraged Lombard loans or other interesting things like listing it on an exchange, but use them and create liquidity in the products that are buying. That's the ultimate holy grail, obviously, of any private market deal, is to create liquidity for it.
And then it will be part of not only the future of renewable energy, but also the future of finance.
Absolutely, absolutely. Where you can imagine that whole value chain between an asset like this, which for most part actually has been inaccessible to most people and capital markets, layered between funds and fund of funds and different type of expensive structures in between. And here we're basically taking the asset and connecting it directly to the investor. And the proof of ownership of the investment security, be it debt or equity, is holding the token directly. So now that can easily be shifted out to any third party at the investor's discretion.
I understand that you sort of have two pipelines. One is the projects, and what is the value of the project that are at the moment up on your platform?
So we went live with this institutional grade platform end of last year. We intentionally wanted to have traction and not fall in the trap of the common chicken and egg situation. So we immediately closed 12 projects with a total investment volume of 12 million Swiss francs. That happened in September, October last year. Since then, we've focused on onboarding new projects to the platform and has now grown exponentially the past couple of weeks, actually, to a total aggregate volume of 1.5 billion Swiss francs.
Was it sort of a proof of concept, the thing that you did last year then?
You can absolutely call that a proof of concept. Definitely a minimal viable product.
Yeah.
Since then, we've actively engaged with those customers, investors, and project developers that have used the platform initially to tailor it further. What was easy? What would you see? What is missing? And actually continuously evolve the product to where it is now, where we're going on a new fundraising process and acquire new investors to fill that 1.5 billion investor ask on the platform at the moment.
Yeah, and then you have to tell us what is your plan now?
So our plan, quite an ambitious one, is that we want to 10x the investment volume on the platform each year up until 2027. Since we did, well, let's round it down to 10 million Swiss franc last year, we want to do 100 this year. And for that, we are preparing a roadshow that will start in the next couple of months that we want to close by end of year where we want to fill those 100 million so that it can be deployed in these very interesting and attractive projects that are on there.
So what you're saying is that in 2026 it will be 1,000 and in 2027 it will be 10,000?
Yes, I think that math is correct. Yeah,
That's what you call big hairy goals, isn't it?
absolutely. I guess we've been a bit taken by good example from U.S. venture space where they're big, go big or go home. I think that's the good saying.
You said that on the project side they preferred debt instead of equity, but do you have a preferred mix when you are going to the investors right now?
So that's a good point. We don't want to be too narrow in our offering and want to leave actually the discussion a bit in the investor's hand. Where do they have appetite? But we see the same split on this 100 million as we do on the project. 70% we envision to be debt and 30% to be equity. But we do have flexibility on the project developer side to negotiate terms on both ends, and hence can be quite flexible on the investor side too.
And what about the investors? Can Nordic investors invest in it, or does it have to be a family office or a bank or whatever in Switzerland?
No, we're quite agnostic there as well. But it has to be said, if the investor is under a regulation that doesn't allow for it to hold tokenized securities, we just need to make sure that the contracts are framed in the traditional sense. We can obviously cater for it. This has been done through centuries, but obviously we would prefer to have that tokenized infrastructure in the back. But this is something that we can absolutely cater for. But there are no restrictions in the end, actually, to where the investor sits, if it's done as a traditional investment.
So you do them regular stocks in the front end and then tokenization in the back end. Is that what you're saying?
Yes, exactly. That's absolutely a structure we can envision, where you have a traditional front end. We could even imagine setting up a green bond where we bundle a set of predefined projects. It can, as you say, Martin, it can be in form of a special purpose vehicle where investors own equity in that vehicle, and that it's directly then deployed. And under the hood, on the asset level, they will always be tokenized, but that the legal structure actually is in Switzerland. But then outwards, it would be a traditional interface.
So you're not going back to the paper stock letters, not even as an NFT.
No, we will try to avoid that as much as we can. In the end here, it comes down to cost. And as we've seen, investors are still very much, while it's green and good, the investors will still ask for performance. And any upfront costs that will deteriorate that performance is obviously something that we don't want to compromise on.
Of course, there's a lot of innovation here, and is it so innovative that you more or less could call it a new asset class?
Yes, absolutely. As I mentioned initially, this smaller size tickets is something that is very new, especially to the traditional asset investors in this space. So yes, I would argue we are opening up a new asset class, and that is thanks to the use of technology along the whole value chain of what we're doing, from documentation gathering, analysis, due diligence, financial assessment and engineering, all the way up to securitization, and actually also post-investment monitoring. If we hadn't been able to standardize that whole workflow, we wouldn't have been able to address and open up this new asset class, as you so nicely put it.
And that is the intelligence here, that you are covering the whole value chain.
Yes, we often use the word one-stop shop for renewable energy assets, and I think that's quite an exhaustive term, where we do really take the whole value chain and compromise it into one digital powerful engine.
So back to the introduction to this conversation then, is this then one of several solutions for the climate change problem that we have?
I would say so, yes. There needs to be more for sure. We've decided to address renewable energy first simply because it's the largest lever in addressing climate change. If you look at renewable energy as a whole, or energy as a whole, including heat, so not only electricity production, but also heat production, it accounts for roughly around 60% of global emissions. So obviously addressing that bucket is a large lever that we can pull. But there should be also other solutions addressing other parts of carbon intensive industries. And also within our own segment, we see and would very much welcome other players pushing the same direction, simply because it will create a network effect across the board.
So then you have the big hairy goals, the 10x each year, and you're also then improving the globe, sort of, or improving the problems of the globe. So does it make you happy, or are you in it for the money?
Uh, Good question again. I've never worked so much and earned so little, Morten, as I do now. So if money was the main motivation, I think I would have quit a long time ago. But obviously, a business needs to work, and that is economically incentivized. But the cherry on top here is definitely that we have a huge impact on addressing the climate finance gap, and that's sort of the goal as well here, and why we want to measure it and measure our impact. And we do have ambitious goals, and if we are able to achieve it, we've calculated roughly that we can contribute to up to 2% of the climate finance gap, which for a small company of our current status is huge, but extremely motivating as well when you break it down, that you can actually move the needle. So I would say I'm not the only one and in the team that is very much motivated by climate and trying to address the problem at hand rather than the financial motivation.
Okay, then we conclude, and thank you, Philip, both for sharing the story about Frigg and also share the mission that you are on, and we wish you luck going ahead.
Thank you so much for having me, Morten. It was a pleasure.